What's up, everybody? Zillow is now predicting that interest rates may go up as high as 8.4%. Home sales will plummet and the housing market will slip back into a deep freeze if the U.S. defaults on the debt ceiling. This could happen as early as June 1st. This would mean that housing payments would increase by 22%, according to a worst-case analysis by Zillow. Home buyers and sellers finally have been adjusting to mortgage rates over 6% this spring, but a debt default could potentially raise borrowing costs even higher and send the market into a deep freeze, said Zillow senior economist Jeff Tucker. So let's see what Tucker is saying and the chances of this actually happening. We'll take a look at a couple articles by Zillow and Fortune and The Hill. So let's dive right in. The U.S. could run out of cash to avoid a default as soon as June 1st if the debt ceiling isn't raised or suspended, according to projections from Treasury Secretary Janet Yellen, the Congressional Budget Office, and the Bipartisan Policy Center. Democrats want to raise the ceiling without any strings attached, and Republicans are calling for spending cuts. If Congress fails to raise the limit in the coming weeks, Treasury Secretary Janet Yellen claims economic calamity would ensue. So what does that look like in regards to the housing markets? In a report published last week, Zillow's senior economist Jeff Tucker said that if the U.S. defaults on its debts, mortgage rates could reach 8.4% by September, which would raise mortgage payments for new borrowers up over 20%. One consequence, in Zillow's view, would be rising bond yields and interest rates, as a default would rattle the assumption of safety for U.S. Treasury bills and related assets. So as a result, interest rates on mortgages would climb, with Zillow projecting an estimated peak of 8.4% on a 30-year fixed rate come September. That's up from about 6.125% right now. Home values might not see a notable drop, but higher mortgage rates would severely impair affordability for first-time buyers especially, Tucker continued. It is critically important to find a solution and not put more strain on Americans who are striving to achieve their homeownership dreams. Mortgage rates have already doubled in a little over a year as the Federal Reserve kept raising rates to fight inflation. At the highest point last fall, the 30-year fixed interest rate was 7.08%, before settling just above 6% in the first half of 2023. This is in conjunction with home prices skyrocketing around 41% during the pandemic housing boom, making the affordability crisis at an all-time high. When we forecast the evolution of the housing market over the next 18 months in the event of such a debt default, we estimate that the existing home sales would fall as much as 23% relative to the no default baseline forecast later this year, and that home values may be 5% lower at the end of 2024 than expected in the no default scenario, Zillow says. A default would also most likely coincide with a sharp increase in unemployment, Tucker estimated, jumping from the current 3.4% to a peak of 8.3% in October before declining. Now, the United States has never defaulted on its debt, and it does remain an unlikely outcome of the current standoff about raising the debt ceiling. But if it were to happen, which could be as soon as June 1st without intervention, it would crush an already wounded housing market. While we don't expect a debt default to occur, if it did, it would have unprecedented effects on the financial system, said Tucker. This would reduce lending and credit availability throughout the financial system. What that means for the housing market is that the cost of borrowing would rise dramatically and sales would be dropping. The severity of the impact depends a lot on the duration of the drama. If the crisis grinds on for longer, all of these impacts would last longer and be more severe, he said. If it turns out to be a more short-term problem, there will be shocks, but I could see the situation where it could come back relatively quickly. With less than 3 weeks till the point where the government can no longer pay its bills, which they call the X date, the point is approaching when the risk will be priced into lending if the crisis is not resolved. Right now, it's contained to short-term securities like 1-month treasuries, which have been breaking records, said Tucker. It's a looming risk about a month away, so it isn't yet wreaking havoc on 30-year mortgage rates. But we're continuing to inch forward into unprecedented territory. One interesting thing that they noted is that even with the worst case scenario, the Zillow economists just don't think that home values will suffer too much. The Zillow analysis projects that if the United States does default on its debts, home values would begin to fall in August, but only 1% from the current levels through February of 2024. Even in this dire scenario, home prices are expected to rise 1% from today to the end of next year. That's down from a current expectation of 6.5% home price growth over that period. Home values tend to fall sharply when the market is flooded with listings, but in this scenario, inventory would be even lower than its already historic low. Low inventory would most likely keep home prices from falling too low. Now, if unemployment does go up to 8.3%, that could cause a lot of homeowners to sell if they can no longer afford their mortgages, which could then possibly bring home prices down if inventory increases dramatically. The bottom line is a debt default would mean a major disruption to the housing markets, reducing sales and increasing mortgage rates to over 8%. The exact contours of a debt default scenario this summer are unclear, but also unimportant for the conclusion about its impact on the housing market. Any major disruption to the economy and debt markets will have major repercussions for the housing market, chilling sales and raising borrowing costs just when the market was beginning to stabilize and recover from the major cooldown of late 2022, Tucker said. So what do you guys think? Are we heading for another major correction or possible crash? Is the American dream of owning your own home over? How in the world are people supposed to afford a house with still extremely high prices and interest rates over 8%? Let's just hope the powers that be come to some resolution in regard to the debt ceiling so it doesn't impact the housing market any more than it already is. Well, we should know very shortly. Interestingly enough, if you look at what's happening in the housing market right now, Redfin just reported that pending home sales have increased over the last week, even with the limited inventory, with nearly half of the homes selling in the first 2 weeks. That being said, pending home sales are down 15.8% year over year, and new listings of homes for sale are down 19.3% year over year. So the market is more active right now in May of 2023, which is expected. We are in the spring market, but is still way down from previous years. This spring's housing market is hot but cold, with scant listings making it less active than usual, but fast and competitive at the same time. The good news is that buyers are out there trying to find a seat in the game of musical chairs. The bad news is there aren't enough chairs, said Redfin Deputy Chief Economist Taylor Marr. Where I am in the DC area, the market is still really hot. I had 3 sales last week, all different areas, all different price points, ranging from $450,000 up to $1.8 million, and they all went in multiple offers and settled way above asking. But what's happening where you guys are? Comment below, tell us where you are and what you're seeing in your local housing market, because that is the best way we can really understand what's happening in the housing market across our country. And if you didn't see last week's video on the housing market, check it out. We went over Zillow and CoreLogic's revised housing forecast, as well as Black Knight's recent research that says we may be back in 2006. Thanks for watching. I do appreciate it. Bye!